Welcome back in, everyone. I hope you're having a great day today. 2026 has had a really bumpy start to the year. As you can see here, the VIX has climbed up to around a 24, 25. We started the year coming in at around a 14, so the volatility in the market has roughly doubled, as well as the fear and greed index is now down to a 17. We're down into the extreme fear. So people are very scared of the market. At the beginning of the year, it started off with fears of AI, how AI is going to take over so many jobs. It's going to ruin software companies. Now we have the war with Iran. Oil prices are skyrocketing and plummeting in the same day. It's very crazy, but oil prices are very high. We've seen gas prices almost double here in the United States. So very rough start to the year. While all the craziness has went down to start the year, we're starting to see a rotation. Everyone's getting out of software. They're getting out of these tech-oriented businesses that can be hurt by seat dilution problems with AI, as well as the companies that are spending big on AI. A lot of the big hyperscalers, the Mag 7, every company in the Mag 7 is down year to date. And they're starting to move their money over to Coca-Cola's, Costco's, Waste Management's, Walmart's, very simple businesses that they believe will be here for a long time that won't have a very negative impact from artificial intelligence, as well as they're well insulated from the oil problem going on in the Middle East. As you can see here, just this is a year to date. For my whole watch list, almost my entire watch list is down big. A few outstanders, ASML, Costco, Coca-Cola, Waste Management, all companies I announced, American Tower, as well as Netflix. I have, what is this, 6 companies in my whole watch list that are green year to date. So, and then you have some huge losers, Duolingo, minus 43, FICO, minus 32, Intuit, minus 27, Adobe, 26, PayPal, 24, on and on and on. All of these are, somewhat tech-oriented companies. There might be a couple, Hermes, a couple other outliers here, but for the most part, tech is being sold off to start the year. I think now is probably the best time that I have personally ever seen to buy stocks overall that are on my radar since I've been in the market in 2021. 2022 was very close. April 2025 was very close as well. Needless to say, this is one of the best opportunities that I have seen in the market. You're getting opportunities like Meta, which I believe is one of the highest quality compounding machines in the whole market. As you can see, over the past 1 year, it's grown revenues at 22%. Past 10 years, this has grown at 27%. As well as some of their other metrics, you can see free cash flow here, free cash flow per share. Over the past 10 years, they've grown it at 24%. Where's earnings per share? Right here, earnings per share. Even with this one-time tax hit that is greatly hurting them in the trailing 12 months. Over the past 10 years, this has grown at 34% per year. One of the highest quality compounders in the world. I believe it has one of, if not the widest moat within the Mag 7. You're getting this company at a 25 trailing PE, 2021 forward. This 25 is closer to a 22, 23. If you take out this one-time tax hit right here in Q3, it cost them like $18, $19 billion. You have other opportunities like Copart here. This one's not so tech related, but you're getting it at a 20 trailing PE, 20 forward. This one has seen revenue slow and actually go down over the past year. Not on a trailing 12 month, but as you can see here, quarter over or year over year, Q1 last year was higher than this year. This is we've seen this with Copart a couple times in their past. We've seen some decelerations. All of it comes down to insurance claims. If they get any downward cyclicality within the insurance total loss claims, like they have here recently, we will see some downturns. As you can see here in 09, 2014, 2020, even back here, 97, it went down. So it happens. It's a somewhat cyclical business, but very, very high quality company. The free cash flow per share over the past 10 years has grown at 26%. Incredible compounding machine here. Earnings per share, same thing, 22%. Compound annual growth rate over the past 10 years. Net income, about the same, 21%. And this is a company that doesn't do a lot of share buybacks. As you can see here, a lot of companies that I invest in, they're buying back shares constantly. MasterCard, Visa, Google, a bunch of them, they're just constantly buying back shares. This company is very selective when they do it. As you can see here, they did it in 2019. They did it in 2016, 2011. Very uniquely, this is shortly after those cyclical downtrends within their total loss claims, which decelerated and even decreased their revenue growth. Same thing is happening here. They're seeing a big downtrend. The stock's down big, down 14% this year alone. Over the past 1 year, it's down 40%. And they had a great cash balance on the balance sheet. They were up to $5 billion in cash with zero debt. $31 billion company. they decided last quarter, let's start buying back some shares. So they restarted the buyback program. I think this is a great opportunity. If you can see here, you're getting it at a 4.4 free cash flow yield after stock-based comp. And historically, this one trades a lot lower than this. Last time you had this chance was in 2017, and you got close here in 2022. Not near as close. This one's often trading closer to a 2. Another great opportunity that I'm seeing here is MasterCard. You're getting this one of the best businesses in the world. I think Visa and MasterCard are two of the best companies that I've ever looked into, I've ever researched. They're crucial to the world economy, especially the United States economy. You're getting it at a 3.8% free cash flow yield, while they're growing revenues at an accelerating pace of 16.5%. Value-added services are taking off like a rocket. Value-added services grew 23% year over year. You have free cash flow per share. Over the past 10 years, it's grown at 20%. Past 1 year, 27% growth. So obviously this downturn in price has nothing to do with the company, like the underlying fundamentals of the business, as you can see. Past 10 years, EPS has grown 17%. Past 1 year, 19%. And the stock is down 13% this year. Past 1 year, it's down 8%. While all these metrics have increased substantially, even over the past 5 years, the compounding fundamentally of this company has been great, and it's only ran up 37% in share price. I think this is one of the best opportunities in the whole market. Like I said, you're getting it at a 3.8% free cash flow yield after dilution. And this one trades historically around a, 2.5 to 3.5 range. The only times it's been higher than that are 2022 bottom, it got above 3.5. Here in 2016, you got it for a 4. It was a great buying opportunity then. I think it is now. This is a company that's constantly doing share buybacks, as you can see here. Past 10 years, they've reduced the float by about 2.2% per year. And they're continuing to do that here. Another great opportunity that I see in the market here is Uber. This is a very, very high quality company. One of the fastest growing companies over the past decade or so. Over the past 5 years, it's grown revenues at a 36% clip. Revenues, 36% clip. That's unreal. Past 1 year, 18%. And they just hit profitability here recently, as you can see in the earnings per share chart. They were losing money for years. Now we're starting to explode to the upside. Free cash flow over the past 1 year is up 42% on a per share basis. Very, very nice. And they just recently started to buy back shares. As you can see, they've been investing in growth, trying to scale the business for years now. And now they think the stock is undervalued, and they're starting to print cash, so they're going to return the money back to the shareholders while the company is undervalued via share buybacks. This was a lot messier to look back on. As I said, it just hit profitability not too long ago, but you're getting this at a 15.6 trailing price to earnings. This is a little fake. They had a tax benefit, the opposite of Meta, but the forward is sitting at a 23, and the free cash flow yield after dilution is sitting at 5%. While over the past year, they've grown free cash flows at 42%. I expect this to grow very, very rapidly, maybe not 42%, but we could see 20% plus growth while you're getting a starting yield of 5%. That compounds very, very fast if they continue this growth over 5-10 years. I think they will be the one true aggregator of autonomous vehicles long term, as long as it's not just Waymo that wins the market. Right now, Waymo is basically the only big player that's actually completing rides. But I do think eventually competition will get into the race with Zoox, Tesla, other players. Uber themselves have also partnered up with a couple small players in the sector. But the only real threat to Uber long term is I could see if Waymo is the one true aggregator within the autonomous vehicle market, they could end up, really hurting Uber's market share, especially in the bigger cities here in the United States. But internationally, and in the United States, they're being able to charge more for autonomous rides. So if they do end up being the one true aggregator of autonomous vehicle, robotaxi, whatever you want to call it, this could be another, margin expander for the company. And you're getting it at a starting free cash flow yield of 5% after dilution. I love this opportunity. Last one I wanted to bring up here is Intuit. This is a company that I just recently bought. There's plenty more on my watch list. I've already talked about Duolingo. I've already talked about Netflix. I've talked about countless other companies in my recent videos. This whole year has been a great buying opportunity for me. I plan on buying stocks this Friday or tomorrow after I get my paycheck, but here we are with Intuit. You're getting this one at a 3.8% free cash flow yield after dilution. You're getting it on a 19 forward price to earnings and a 29 trailing, while at the same time they are growing revenues at a 17% clip year over year, which is accelerated. from 2 years ago. They have about an 85% market share in the mid and small business accounting and tax filing business within the United States. They're yet to grow much internationally. I think they will get there. But the fear is AI is going to take over all of this, bookkeeping, tax filing, accounting within small and mid-sized businesses. I think this is way overblown. I actually think this will be a great growth tailwind for the company, as well as a cost cutter for the company long term. But like I said, you're getting it at a very, very, very fair valuation. I think it's a monopoly. It's going to continue to compound past 10 years. You've seen it grow at 23.5% on a per share basis here with free cash flow. 1 year, 21%. Phenomenal growth here. Earnings per share, it's grown at 24% over the past decade, 44% over the past 1 year. We're obviously not going to continue to grow at 44% at this size of a company, but I do think we'll see give or take 20% on the per share growth of this company intrinsically. Another great capital allocator here. As you can see, the return of capital has just gone up so much over the past 1 year. It's up 40% within their dividends and stock repurchases. They actually, here recently, they came out and said that the company is so undervalued that they're stopping their planned, regularly scheduled insider selling. So the management team, they get paid in stock, and usually they constantly are selling their shares as their payment. They actually halted that, and they for upper management, they're no longer doing that, and they're ramping up the buyback machine. So you're going to see this. As you can see, it's already started to ramp up, but it's going to continue to ramp up. They're pouring out free cash flow, and the balance sheet is in a fine point here. $6 billion in debt, $3 billion in cash. So $3 billion negative net. They could pay that off in 6 months here with their free cash flows. Just look at this. This is their past 10 years valuation of free cash flow for their free cash flow yield. You're getting it at like I said, it's about a 3.8 after dilution, but they've always had historically high stock-based compensation. It's actually decelerating, but you're getting it at a mid-5s free cash flow yield. It even got up to a 6.8. I actually bought it there, but after the recent earnings report and a little bit of a rebound in the stock, you're still getting at a very, very severe discount. The closest it's ever been here is 2020, when the whole world was ending. It got down to, what is this? It's like a 4.5%, 4.4%, and you're still getting at a significant discount to today. I think this is a very high quality compounding machine at a great discount. Same thing here with price to earnings. This is the opposite. You want lower here. It got down to a 23 price to earnings. Now it's sitting around a 28, 29. We've only seen it this low one time ever in the past decade. That was in 2016. Obviously, if you bought the stock in 2016, let's see what your returns would be. You would be up 16% per year. You would have bought shares around $100, and today they're sitting at $450. So I think that was a great dip to buy. I believe it's a great dip to buy right now. And a lot of the companies that we're seeing, money moved into is companies like Walmart here. And I think investors really need to be very careful here. You look at Walmart, very high quality company. It's not going anywhere anytime soon. It's too entrenched, has way too many, locations. And they do have growth sectors with their membership. They actually collect more membership revenue than Costco does, even though Costco is the membership model. But needless to say, you can see here, past decade, revenues has grown at 4%, inflation's around 3%. So revenues have grown at like 1% clip. Past 1 year, sure, it's up a little bit more than it was on a 10-year basis, but it is decelerating compared to the 5 and 2 year trend here. So the company's not going to grow very fast. I don't see anything that's going to make them grow very fast in the future. And the free cash flow over the past 10 years, it's almost flat. Free cash flow per share is down significantly from 5 years ago. So over a decade, it's grown free cash flow per share. The amount of cash they're pouring out, after all expenses, it's barely up over a decade ago, even with, how much inflation has gone up. 3% per year compounded. It's probably 50% over a decade, maybe 60, 70%. But all of that, and you're paying a price of a 1.5% free cash flow yield and a 44 trailing earnings, 41 and a half forward. Sure, the company's going to be here for, the next 20 years, probably, if I had to guess. It could be around for 50 or 100. If it was around for 100 years, it would still be a good investment today. But I do think there's just a lot better opportunities out there. You really need to be careful. This one has ran up a lot. It was a lot higher than it is now. It was at 133. It's traded down here some to 122. But over the past year, it's up 40%. If you were ever going to buy Walmart, it's just not the time. It would have been 2022 when it was at $40 per share, and it was still making relatively the same amount of free cash flow per share as it was then. It's not like the company has grown intrinsically so much since then. As you can see here, 2026, $700 billion in revenue. 2022, we had 500, 600 billion. So, I mean, nothing too crazy with the growth. You're just paying a lot higher valuation. Another great company here, Costco. I would love to own Costco one day. I think it's a great company. I think it's higher quality than Walmart. I think it will probably outlive Walmart and outgrow Walmart. You're seeing a lot faster growth here, around 8, 9, sometimes, 7 to 10% growth here is what you're going to get with Costco. It's always going to grow. They still have so much market to take. They're very successful internationally, and I think that's where they're going to be expanding and growing more in the future. They will grow in the United States more, but needless to say, this one's a much more high quality grower. They buy back shares and they pay really big dividends, as well as their one-time special dividends that they pay, every 3-4 years when cash gets too high. That to say, the company's trading at a 51 trailing price to earnings, 46 forward, and a 2% free cash flow yield. Much better buy than Walmart if I had to pick, but I just don't think now's the time to buy Costco. We can look historically at the valuation here. Price to earnings, it's around a 50. And you had times over the past decade, you could have bought it at a 27, 25, 30. If you bought it here at a 33, that's a much better deal. 2020 at a 40, much better deal. Here, even in 2023, a 35 price to earnings for this high quality company. I don't think that's too bad, but I do think a 50 price to earnings is too high. I think here at 46 in the back end of 2025, that's too high. It is a great company. If I own shares, I don't know if I would trim. I would definitely get close to it at these prices. It's up 14% year to date for what? It had a great year last year. So just watch out there. I know whenever you see stock prices go down and then other sectors go up, you're like, oh man, Waste Management, Walmart, Costco, they're so defensive. All this fear, everything's different this time. I need to get into a very safe stock. Don't fall for it. Over time, be optimistic. Optimism wins, especially here in a capitalistic, society here in the United States, in the Western world. There's going to be some fast-growing companies, and Costco and Walmart over the long term. Like I said, they will be good companies, good investments. Let's look at Waste Management here. This is another one, 35 trailing PE. This one's actually not near as overvalued as the Walmart or the Costco, especially Walmart. It's similar growth to Walmart. It has accelerated, but another one that's just ran up too much for me. I would invest into the company. Look at the debt too. $22 billion in debt, almost zero cash. $22 billion in debt for a $94 billion company. So you're basically paying, the price to earnings is a lot, more generous to the valuation of this company with that big stack of debt. $22 billion added to the price of this company. So you're basically paying, what is that? $116 billion for a company that does $25 billion in revenue and it's low margin. So like I said, just be careful. Whenever stock prices go down, that lowers your risk. Whenever stock prices go up, that raises your risk. So you want to be nervous when your stocks you're holding are going up. And whenever your stock prices that you're holding or looking at buying go down, your risk and your total returns are greatly increased. Your risk is decreased. Your total returns will be greatly increased if you get it at a discount. So I don't think investors should be, looking for companies that are cheap. Don't just, go to make a screener, look for 52-week low companies, or just look at companies that you see other people buying that are cheap. I recommend really digging in, finding high quality companies. Like for instance, the ones that are running up right now. I think Costco is a great company. I think Waste Management's a great company. There will be a day in the future where they're, undervalued or fairly valued, which will be a great time to buy them. But today's not that time. So find great companies that you think are going to be around 10, 20, 30 years from now, that are going to be doing a lot more business. They're going to be a lot bigger, a lot heavier companies. Their net incomes will be up a lot. You don't have to have an exact number. If your company grows 14% intrinsically per year for 20 years, you won't notice a difference if it's 14 or 16 or 12%. But if it grows that much for a 10-year, 20-year, 30-year period, you're going to do great. If you get into a really cheap company that starts to falter, that sees, competition enter its space, or margins get pressured by competition, or disruption by AI, or whatever risk to the business. So you want to make sure you're looking at quality, but at the same time you want to take into account price. So I think right now is a great time to buy stock. Some of the names that I pulled up for you guys, the Intuits, the Ubers, the MasterCard, the Visa, the Meta, a lot of great companies out there. A lot of tech is being sold off. Some of people's favorite investments, the Mag 7, a lot of them have opportunities right now. I think even Amazon's a great opportunity. I think Google's fairly valued. So there's some great opportunities out there. Don't be scared of, the macro effects or the war. All that's going to be flushed away. The United States, the Western world, the world as a whole will continue to prosper. And if it doesn't, I don't think you should be too worried about your investments. So stay level-headed. I think right now is a great time to buy stocks. That's all I've got for today. Make sure to drop a like and subscribe on your way out, and you'll have a great rest of your day.